Alrighty, welcome back to smartplane.com live financial modeling. We're going to finish up this food truck model. Yesterday, I got all the tabs in here, did all the references for that, fixed some broken things. It wasn't too complex. This is just an annual only model where we've got some pretty straightforward logic for revenue, and then expenses are all percentage of revenues. Um, Today, we're just going to finish it up. So, 1 second. Let's get the link out. Food truck. Food truck. To Twitter. So this one is, we're getting down here. We've upgraded all the startup models in our top 50 are almost done. We just have we're here. We'll do general rental next week. Then we've got janitorial cleaning service, enterprise SaaS. This is a huge one. And lending business already has a 3-statement model. So we're almost done with our all the startup models in our top 50. Note the template I'm doing today is in the industry specific bundle, and down here is the fourth template I actually did in this food truck model. This is what we're doing right now. And then if you want to check out more templates, go to the Finish Models tab at the top. I sell in bulk. You can buy by type, mid-level, intermediate, upper tier, ultra, and there's a color code key. You can see all the templates through here and all the categories, or you can buy by category or by bulk, or buy all those templates on the site for $9.99. Tons of value there. Okay, let's get into it. So the income statement looks completed from yesterday. Just making sure. Okay. All right, we left off fixing the CapEx because we had to add in this year here to figure out the right depreciation for the cap gain if you're applying any of the exit value to fixed assets. So that was the last thing we fixed before the stream ended yesterday. I'm glad we figured that out. Equity required, we're going to do that. Okay, let's go. So income statement, let's go to cash flow. So revenues, that's good. Other OPEX is C15, C25. Yep, that's good. And we've got interest and taxes. Okay. CapEx. Now, makes sense. This is why I use the open pit mining model as my template, because for this, all of the CapEx is happening in month 1, which is just your food trucks and any equipment. And that's not going to be dynamic as far as the date is all going to be right up front. So for CapEx, it's always in year 1. So that's fine. That's why that's hard coded in there. Now the sale of the business is dynamic. It could be any amount of years. The value here, we got 585. We're taking the EBITDA in whatever year the end month or end year is. So 487, that number, times whatever multiple we put into here. So 2x, it's 975. Now we've split that between, you can see on the terminal value, 60% as extraordinary income, 40% to fixed assets. I'm going to change that to 90. Okay, perfect. And so this is sale of business, sale of depreciable assets, including the top row. So 1,225,000. That's going to be all of these together. Yep, perfect. And then investing, or financing activities, we just have the debts, which is also, now did I make this dynamic? Let me see. Okay, no, this is automatically at the beginning as well, so that's all going to be in year one, whatever the amount is. Principal repayments. Now, what's going on here? There's definitely principal being repaid if D5 is greater than terminal value D3. Zero. Okay, why is this? It's 2021. So it's not greater until over here. Ah, got to change from L to M. We had an adjustment on the column there, remember. And if we do choose to include terminal value, it's going to pay back that debt on the exit year. Otherwise, it would just be the regular principal payments that you see. Raising money. Okay, so equity financing. How do we want to do this? It's basically going to be equal to all the startup costs. So equity requirement, and we only have this on an annual basis, so we have to say it's kind of its own schedule. So period 0 is going to be all the startup costs. Oh, we can't even do this yet. So cash flow. We got to put other cash flow items in here that we didn't have in the original. So EBITDA, let's add in taxes, CapEx, exit, proceeds. Now I believe, is that everything? Taxes, we have that in there, this is in there, that's in there. CapEx, and that'll be in there. And borrowing money, that's okay, we're good to go. Format all these the same. Whoops. And then exit proceeds. We'll add these two, sale of business plus sale of depreciable assets. Okay, and now cash flow. We can just sum those all up as well. We'll give a margin in here. EBITDA divided by revenues. Okay. So this needs to match. Cash position, we don't really care about that now. We're just going to assume we're solving for the minimum needed. And for that, we need period 0 plus CapEx, whatever that is. and then we'll go 1 to 10. So here, so that's all of that. Then we also have to include, so this is going to be revenue plus expenses. We've already got startup costs. Oh, financing is going to be against period 0, so don't worry about that. We're going to add in debt service, taxes, and exit proceeds into this number. So that should have everything. Period 0 also has this financing amount. So here, equity requirement is 256. If you had burn, shoot, we have a reference error. All right, hold on. Let's continue on through. We might just get it while we're working on this. So minimum equity required, we'll just take min of this row. So 258,000 to get it off the ground. Then that'll flow to the cap table. You can define contributions here. Let's see, cash flow's got that. Just make sure we all match up now. So, and this could actually be an internal rate of return calc as well. We might, all right, so let's make sure this has everything first. Cash flow, non-current assets. We're balanced. Equity, retained earnings. Okay, good news, we're balanced. Question is, normally I solve for, I guess because we're doing it annual only, we're not going to get a 0 solve here. Because I guess it would be period 0. It'd be just this plus this. Yeah, so period 0. That makes sense. And then let's look here. So this is cash flow statement numbers. Match, match, match. This matches. Okay. If that matches, what did we do here? Revenue, expense, debt service. In this, where's this number then? We have to have these startup costs. They would be in here. 346.6. So that's all of that. So if that's all of that, how are we matching here? Well, I guess it zeroes out. So the amount you're raising is actually plus the debt plus this plus, what does that give us? Minus the startup cost. Yeah, okay, so that's just zeroing out, so that makes sense. The initial startup cost and all that zero out, and then all you have left is the operations for year 1, which is 96, which matches this. Okay, so that's fine. Just want to make sure all the references are good. Cash flow. I think we're good here. I think we're good here. So we have our 3-statement modeling done. Now I want to move to executive summary. So here we'll just do, so this is not mining revenue, this is total food sales. And we could put in like a nice metric here that says something like Like we could put in total sales per year. And then that's going to equal, I'll give a later text. That would just be total revenue divided by VLOOKUP year range. 2. Oh, that's not right. So annual detail C4 should be revenue, right? Divided by, oh, average order value I want. I don't want this. I just have that I want. Oh, we can just add it here actually. Sales per year. And it's just this times working days per month times 12. Or orders, release orders per year. So we want H, X, just look up H based on the year range. C, D, E, F, G, H, so 6. Alrighty. So there's our orders per year. Oh, if this equals 0, then 0 it out. Okay. Gross profit. I'll give this if error. So it looks nice if you have less than 10 years. Now, what's going on here? Salaries and wages, sum of annual detail. It would just be this. What did I have before? G39 to G59. What? Oh, duh, because so this model never had an executive summary like this. So these all got to be updated. Okay, that makes sense. So salaries and wages makes sense. We have other OpEx is going to be the rest of it. So food costs and other. Gross profit. Oh, so yeah, we do have cost of goods sold here. That's going to be food. Let's put that in. And then other OpEx, so we don't need 7. So this is just C9. All right, total expenses, EBITDA. Let's make sure this matches 4,034,000. No, it does not. We're off by something. Let's see. Uh, revenue. Make sure this is right. Yep. We might be missing a cost. So we have 8, 9, 7, 8, and 9. Yeah, that's all this. What are our total costs here? 5,004,000, 7,335, 7,335, and then total cost 3 plus 2. And we're doing this. Ah, I see. So this total expenses needs to add in our cost of goods sold. Now we're at 1,907,000. 1,907,000, perfect. All right, so we're good up to EBITDA, and this is just a high-level snapshot, kind of like this, but just more, a little bit different format. This is up to 10-year, 10. Okay, one sec. Okay, so other items, taxes. We've got that. CapEx. We're just going to pull from the cash flow statement. Debt service. We have that here. We're just going to go all year one. So startup costs. Proceeds. Loan proceeds. And yeah, we're not going to separate these. Okay, and then cash flow, just EBITDA plus all of this. All right, and then we're at 2,196,000. Where do we end up here? 2,196,000. Let's put cumulative. This is not relevant anymore. If you want to do an IRR, this would be the calc to do. So period zero and then future cash flows. Cumulative, we just go equals there. Equals that plus here. So 2,196,000 is our number. Plus any equity would be equal to the cash balance on the balance sheet, which looks right. Very good. All right, so this is everything. We'll have to update this. Well, let's update distributions. So here, essentially, is going to be summing up anything annual that's anything in 41 if the period matches. Except for period 0. So annual 41. And it's possible if your sales volumes are lower than what you think your costs are. I mean, maybe you expect to, for whatever reason, you're going to run a loss at the year 1 or 2 as you scale and get bigger. Or if you want to plan for the worst and see what that might be, that'll account for that equity requirement if you do have some burn. All right, so we want to match that C1 with row 1. Not 4. And then here we'll do the same thing, but anything less than 0. And I'll show you what that will look like if there was something less than 0 after we're finished here. All right, remaining equity to use. So this is going to be total amount plus, actually it's probably going to be 0 here in this case, plus capex plus startup costs plus financing. Those are all the things that go into here. So 0, that makes sense. Contributions, yep, that's right, 258.8. And then here's the cash flow. So here's our project internal rate of return, discount rate. Here's the net present value. And then based on the cap table, owners, contributions, investors, contributions, and resulting net present value for each of those. Make sure this matches. So 2169, that looks right. Yep. Let's quickly look. What if we made sales? What if we only made, 25 sales? Well, actually, these are all defined percentages. So you'd have to say, let's say your food costs were greater percentage. Well, no, actually, so this model wouldn't let you have a negative operation income. It would be negative if your debt service was higher than your operating profit, or if your if your debt service was higher. It's possible that you can't cover this if the numbers were different. Let's say you had a bigger loan, let's say $250,000 loan. You're only putting 33,000 in yourself. So now your debt service is 19,000. Now what if your revenues were not that much, like 25? Still, you got plenty to cover. Let's say 5. While still barely enough to operate on, even in those conditions. Oh, no, 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 I'm looking at the wrong row. So I want to see cash flow. So here you would have operating losses if your gross profit, EBITDA, wasn't greater than debt service and then any other costs. And then your minimum value would be the equity required. So now you're at 33. Let's see, does that make sense? Min of 42. Oh, okay, good. Caught it. That's got to be 42, not 41. So now you're 105,000 equity required. And now you see the zero solved there on the cash for balance sheet. That makes sense. Okay, good. This is just a good check. Here, so you end at negative 44,505. Yep. So paying back the debt. Yeah. Okay. Okay. Yeah. So you can test some extreme situations here if you wanted to. Let's go back to like maybe 25 sales a day, maybe 30, maybe 35 stabilized. Price is probably higher. Okay, yeah, still a little bit of burn in year one. That's okay. All my numbers are arbitrary, so when you plug this in, you put in your own data. So we have annual detail done. Executive summary looks good because we imported the distribution tab, so this is already set up right. 5817. Yep, looks good. All right, perfect. Well, what is a return? So here we can update this. So IRR is going to be this row. These are the cash flows. Let's run this through to year 10. We'll do our sanity checks. So all these numbers are already, we don't really need any of this actually. This is all existing elsewhere. This is like all of this data, and then we also have that here for the project and for investors versus owners. Now, do we want the chart? Yeah, we could put the chart in here. So I'll show, let's see, remove this. We'll look at cash flow, but I'll have to update the label there. So this is cash flow per period and then cumulative. Okay, put this down to low. We'll label this. This is cash flow for the internal rate of return calc. So there you've got cash flow cumulative. Now, oh yeah, because that's like zero, $200 for the first 2 years. It's low. Let me update these. Let's put this a little bit lower. Okay, now visual. There we go. So you can see the cash flow and the cumulative as it adds up. Maybe we'll do like a 4x here on the exit. Oh, because you got a debt repayment. I was just saying, why is the last year so low? Even with the exit, 300,000. Uh, we are off a period. Watch this. So this is actually we need to reference the same periods here. We have period 0 only on the bottom. There we go. I was looking for the big bar there. It didn't make sense. I was like, where is the exit? All right. That looks good. Basically shows you when you cover the equity requirement after all the operations and payback and everything else. So that's good. Sanity checks, and then I'll do an index tab that explains each of the different tabs here. One sec. Okay. So balance sheet, annual. Let's make sure this is matched up. Oh, no, we do have an error. Okay, so we'll have to fix that. Let's get in here. So 16,380. What are we missing? Hmm. 16,380. Well, the question is if we change this 2029, now it's okay. So something's happening in the final period. Sixteen three eighty. What is that difference? Is it this? No, it's 24,000 difference. This is paid back. What are we missing? Is this still matched? 544, 367. 544. Yep, that's the same. Puzzles, puzzles. We've got a problem. What is this difference? Let me look at the CapEx. Ah, this amount to be applied to CapEx. So this is saying these are all fully depreciated. And besides this one, well, actually, no, this one is as well. So this 250 is in there, but we have to say 100%. If capital assets are fully depreciated before X year, this should be always be 100%. So there you go. And then now we probably don't have the error. Nope, it's balanced. Okay, so it's just the cumulative depreciation. Or I mean the gain on fixed assets. All right. So that's fine. That works. Sanity checks. Annual check against balance sheet. So this is simply we take our annual here minus this minus initial or plus initial equity required. Okay, let's make sure that works. If we do, okay, good. So that just goes to the end, perfect. Executive summary to annual cash detail. So that's going to be this number minus this 27.2. Okay, hold on. So this is 320. This is 293. What are we missing there? Match, 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 match. And then this is net 144. This is 172. And that's what we're out by 27.2, right? Yep. Okay, so that's the difference. Let's see. So something in year one. Which is the correct number? It should be this. The annual detail. 27.2. So we've got EBITDA, CapEx, debt service, startup costs. This is 144. CapEx, financing, startup costs. Am I double counting anything? There's that. Nope. All right, EBITDA 19.5, 19.5. Taxes, CapEx, exit 270. CapEx, taxes, exit is 270. Debt service, startup cost, loan proceeds is 105. Debt service, startup costs plus loan proceeds, 78,480. This is 105. What am I missing? Startup costs. This needs to be negative. Good catch. Okay, so now 293, 293. This is why sanity checks are so good. There's little errors like that, especially when this model we're doing a lot of finessing. It's very important to have that right. Okay, so these are now good. L35, yep, 35, 42. Distributions to annual, so cap table, let's look at this. Are we matched up here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This needs to be IRR. For each individual, and then we could do aggregate. I'll give this a little format. Okay. 1042, 1.0. Make sure that matches 104. Yep, -1. Again, these are just arbitrary numbers that I put in, so we can just put this back up. Let's say less that. Let's say 50,000. And let's do greater sales. Okay, still negative. That's fine. Just gotta make sure it matches. Also, so I did all these in 9. I don't know why. It should be 11 like everything else. Now, good news, this matches our distribution, so that sanity check's nice. Our percentage IRRs match. Distributions to annual net. Okay, so this one, annual ending cash flow. Perfect. And then individual distributions is just the cap table. We just did that one, and that's good. All right. We are good to go on the food truck model. Fully upgraded. All checked out. You can update any cells in yellow and the model will update. And we'll leave it at that. I'll post this up tomorrow, do an overview video, and then I'll see you guys on the next one. Next week, like I said, we'll be doing, what are we doing next week? The cleaning service? No, general rental business, general rental. So that'll be next week. All right, guys, see you on the next one. Don't forget, check out smartly.com. You can buy templates in bulk and individually or by category.